This is a talk about going through the investment clock, but it's going to be specific to gold this time, and it's different for every commodity, and every cycle is different. So basically, given everything that's happening, China's zero COVID-19 policy, supply chain disruptions, global inflation, the Russian invasion of the Ukraine, all these trends can be different. So what I'm trying to do here is show you that clock in different slices. Show it to you by exploration. What are the trends in exploration expenditures? Show you it by M&A activity. What's that signal telling you? Show it to you by balance sheets. And what you'll see is there's a dichotomy and between some of these signals, between buy and sell. And then we'll also talk about financing, which is obviously very important for the junior sector. And then another thing that's rearing its head, especially in the precious metal sector, is shrinking margins because of the cost escalation. And the other thing, on a positive note, the reserve prices for most majors hasn't changed. It's still around $1,200, $1,250. But the new technical reports that are coming out are at $1,500 plus. So when you look at M&A, how's that going to happen if some companies are using $1,250 and the only way this thing's going to give you a 15 or 20% IRR if it's at $1,500? So one of the triggers might be, do the majors start increasing their reserve prices? So this is the clock. It's very busy. And just so you know, on Exploration Insights, we usually sometimes put out a free rant that I do, and this will be one of them. So it should be out on our website in about a week. But basically, it's going through from crash, improving sentiment, boom to bubble. But what I'm going to do is look at several aspects of these indicators. So the first one, I'm looking at exploration budgets, just that slice. How does that look like? Where are we at? So if I look at that from gold exploration from the late 90s, gold exploration peaked in 2012 at about $10 billion spent globally on gold exploration. So that's the yellow bars. The black line is interesting because most juniors are explorers. And what you'll see is that the proportion of exploration that's actually directed to grassroots exploration, like going to greenfields properties, has actually gone down quite a bit and is sticking around 30%. But juniors have a bigger influence on the grassroots part because what you'll see is the majors are doing much less of that. So, but after we had that peak, it went down to about 6.1 billion. It's come up again more recently too, that 6.1. And like I want to emphasize here that juniors control a higher proportion of the global budget here than in copper and in other commodities. In gold, they're more important. So if we look at it from a major standpoint, and so the bar is how much VRIC spends on exploration and what they call development, but development that they can capitalize, but it's not to actually build a project. And then the line is actually the percentage of that normalized to their revenue that year. So how much are they spending of their revenue? And you can see back in 2000, they spent about 8% of their revenue on exploration. That trend has gone down to an 8 or about 2%, come back up to 3 or 4 post the Nevada gold mines consolidation. It's back to about 2%. But what I would argue here is what matters is a stable budget. You want a stable budget, get a team in, give them certainty over at least 5 years that they could do what they want and they're not at risk of being cut within that time frame. And when you give these people stability, give them a program, they could do it, the probability of making a discovery is much higher. So, grassroots exploration, do we actually find anything anymore? And so this is interesting because I was just down here at the GSN symposium a couple of weeks ago, and a major actually found a grassroots discovery in a well-trodden district, Mother Lode in Nevada. So when I tweeted this out, a person was telling me, oh, it's great that majors are doing grassroots exploration in new frontiers. And I said, well, this is not a new frontier. This has been around forever. But what's changed here was when they had the Yucca Mountain nuclear facility where they were going to put all their nuclear waste, there was an easement where nobody could actually take any ground. And as soon as that easement was lifted, a junior, Renaissance Gold, which was part of the Long Canyon discovery, that same group became Ren Gold, and they staked this ground. So in Nevada, you can't stake by computer. You actually physically have to go down and stake it. So they staked it. They took samples from the surface. All they got was this chalcedonic blanket. It was altered, but it had no geochem. Mercury, but nothing else. No gold. And so they dealt it to Anglo, who was keen. They took the project. 5 years later, from then signing that agreement, they declared an inferred resource of 3.4 million ounces at about a gram of open pit, amenable, heap leachable gold. And when I went there, there's an easy sight to 5 million ounces. And that, again, is in Nevada. Okay, so we're still finding things in well-trodden districts by actually drilling. And as you can see, the high-grade part of it is undercover. It's not visible. So we can still find things. And majors, even though they're not known for it, some of them are actually discovering things, which is good. So if I had to do this on the exploration side, I would we're still in the sort of latter part of buy, with discoveries getting noticed. What we want to watch is when that exploration budget declines. And as I said before, the issue is that, a good proportion of the grassroots is done by juniors, and it can be fickle because they're funded by equity markets. And if the equity market is not there, the grassroots budgets for gold will decline because they're a bigger proportion of it. Okay, so let's look at it from an M&A perspective. From when companies did asset write-downs to the mega mergers, consolidations, to low-risk M&A, to higher risk. So where are we in that sort of clock? So we've had our massive write-downs. So this is a graphic of VRIC, and I'm not picking on VRIC, but they have a lot of their data that's easily accessible. So multi-billion-dollar write-downs, the Pascua-Lama, that was probably the second version of write-downs, because I remember the write-downs from the late 90s when I lived in Argentina, and this was the second round where they spent even more money that they had to write down. So those write-downs took another 5 years to get over. And then they basically got to a point in about 2016 where they were done. And now they were investing better, and they didn't overspend. And so what you see here is the number of transactions on the side there in the inset have actually gone up for grassroots projects. As majors are getting more into the grassroots, they might not be doing it themselves, but they're getting involved with the juniors as a proxy for their lack of grassroots exploration. Mostly in gold. That's not happening in copper. Rio Tinto still spends about $100 million a year on just grassroots exploration. So in copper, the majors are much more important than the juniors, but not so in grassroots gold. So we're okay with respect to the massive write-downs, but now we're getting riskier M&A. And so I've looked at Pretium, high-grade deposit, controversial resource, but they were generating semi-consistent production, good margins, and free cash flow. Newcrest had made their purchase of Red Chris. They were in the neighborhood. They could basically treat the concentrate that came out of there. There was a little bit of synergy, and so it was acquired. So out of 4 to 5 years of this being a controversial asset from startup, they did a great job of building that in a remote part, brought the grid line in and everything like that, and then it got taken out. But still, this was still a controversy. You didn't see a multi-asset bid for this 300,000 ounce producer that was permitted operating with, at least a 10-year mine life in British Columbia. A lot of people were not interested. still, but it got acquired. And then we look at this, some very strange M&A transactions. So basically Dorothy is the investment banker, the wizard is the suitor, and then we got the Tin Man, the Lion, and the Scarecrow. And so First Majestic bought Jarrett Canyon. Whatever. But, this thing, I mean, they're a silver company because it says First Majestic Silver. But they're going to get 5 million equivalent ounces of silver from a project that doesn't produce any silver. So that's where equivalents sort of throw that out the window. But again, this is a refractory ore project in the middle of nowhere. We're with a roaster, a lot of dilution underground. And what I'll show you is that last all-in sustaining cost from Q1 exceeded the gold price by about 35%. Unusual M&A. Another one was Tora Peru, where they tried to do a three-way merger. That failed, and so GoldX Mining ended up being purchased by Gran Colombia for this low-grade deposit. Another one was Evolution. Evolution bought Red Lake from Newmont. But the great thing about Battle North, which was formerly Rubicon, is they had a 2,000 ton per day plant, and that's what they wanted. And if you look, if I take you back to Silicon, the Silicon project that Anglo Gold discovered in Nevada, they bought Corvus, right? And Corvus had the ground to the south. You read the technical report for Anglo on the Silicon project that they released, and I would encourage all of you to find it on Edgar. One of the big things was getting the water rights from Corvus. Because now in most of the Western USA, we're in drought conditions. So if you don't have access to water, you're screwed. And if you have to compete for that water access, again, screwed. And now, as we had the Rosemont decision, we saw what happened with Trilogy and South 32 in Alaska. If you're not on private land, you seem to be semi-screwed being in the States. So be very mindful, even if they've got a permit, that these guys, these NGOs can come and maybe get it revoked under this current administration. Okay, another one was Great Bear. Great for the equity guys that own this tight share structure. They drilled it correctly. They started at Dixie, that wasn't holding together, got to the LP fault, put together a story, but not enough of drilling to get a resource. But thankfully, they got taken out before the resource. And even though, this is a $1.4 billion transaction, it was said that VRIC bid, but I heard from other people that wasn't the case because they didn't want to pay the premium. But again, not a multi-bid potentially, but a risk in the sense that there's no resource here. I've seen that before with Caden Resources and Barqueño with Agnico. I went on a site visit with the junior. They were drilling widely spaced holes just to show there was mineralization. And when I went there a year and a half later, when Agnico had it, nothing was done because they couldn't permit a lot of the drill holes, the same problem that the junior had, and I'm not even sure where Barqueño stands. But that wasn't a cheap acquisition. So buying things without a resource, I would say, is kind of risky. So another one, this is not an acquisition, but this is a transaction. So given what's happening with copper, that it's a tight copper market, there's not a lot of development assets, and what's happening in the States, what's happening in Chile, what's happening in Peru, suddenly Pakistan makes up its way to number one for VRIC. So they're willing to spend about $7 billion over 3 to 5 years building this huge copper gold project that's basically wedged between Iran and Afghanistan. So that's where we're at. So again, risky geopolitically. So if I had to put this on the M&A, it's almost like we're getting into the sell part of the cycle. And that is when we have the write-downs. So if we look at balance sheets, usually this is something that's very important. If we want M&A, we need good balance sheets. And if we want these guys to survive higher costs, they need to have the capital to do it. So if you look at it, again, VRIC, I apologize to everyone that works for VRIC. Yes, I did work for Newmont, but I'm not taking it out on you. You just give more data. Okay, so if we look at a net debt position, so this long-term debt minus working capital, the more positive the number, the worse it is. You want close to zero or even negative. That shows you're healthy. But look how long it took VRIC, about 8 years, to get from their big net debt positions to basically to zero to negative. And they want to stay there. And with somebody like Bristow at the helm, I doubt that they're going to make a lot of stupid M&A transactions. So what these guys were doing, VRIC and Newmont, after all the consolidations and the mega mergers, were divesting their non-core and getting cash for it. And in a good equity market, there's money to buy those assets. Right now, it might not come from the equity market, but it will come from private equity. Private equity will step up if there's still any more divestments to happen. So if you look at another one, Pan American Silver, in terms of its net debt, you can see its working capital position in light green. You can see its long-term debt in sort of pale red. And then the line is their net debt position, which is getting more and more negative. So they have an excellent balance sheet, these guys, and they're actually increasing their dividends, which helps them attract the generalist investor that everybody wants to attract. So in terms of the balance sheets, we're good in the gold sector. It might not be for everybody, but right now with the majors, it's good. If we go with what we deal with the juniors, is capital raising, and all the capital is hopefully not from debt, but from the equity markets. So if we look at that, so this is just Q1. So I'm comparing Q1 funds raised directed to gold exploration or gold companies. And so you can see that the total fund raised is the yellow bar, and the number of financings is the dashed line. So I'm not showing it here, but the financings for base metals and specialty commodities over the last year has been higher than gold. Copper's seen more money, nickel's seen more money, and lithium's seen a lot of money. And gold's gone down the list in terms of what can attract capital from the equity markets right now. So the first quarter of 2022, which was the end of March, was the lowest amount since 2018. From 2 years ago. We had a lot of money raised last year. We're not seeing the same amount of money. But unfortunately, some of that money in that Q1 was raised by a metallurgically challenged project that has been around for more than a decade that raised money from a movie theater. So what happened here was VRIC Capital, a hedge fund, owned a lot of AMC. They also owned a lot of Hycroft. I guess they talked to AMC, and Eric Sprott put in $28 million each. They own 22% of the company. That company's CEO was desperate to raise money at 30 cents because they were out of working capital, and their project, again, wasn't working. The same metallurgical process that they keep beating their heads against the wall still doesn't work. And so they ran out of money again. And so they were very willing to raise it at 30 cents. The raise with AMC and Hycroft increased the share price because they did it at about $1. But then AMC bought the Reddit crowd. And the Reddit crowd, they do trades of $50, $100, and their target is not this big resource, or they don't care about management, they don't care about metallurgy. All they care about is the hedge fund that's shorting them. So all they say is, here are the shorts, here are these greedy hedge funds, let's get them. And if you read the Reddit dialogue, that's all it is. And that's what their target was, and they did a good job. And what did the company did? They raised $140 million at an ATM facility and took full advantage of it. So a brilliant move, but asset quality and all that got nothing to do with that. And that's a lot of the money that was raised in that quarter. So in terms of the cycle, we're getting more to a sell in terms of what the transactions are looking like and how much is being raised. Let's look at operating costs. This is very important. because what we're seeing is increases all the board. So if we go back to Pan American, and you could see in, I think it's Q3 20, their operating margin at the mine site was about 40%. Now, at the end of Q4, I don't have the latest quarterly numbers, but it was down to 18%. The silver price dropped, but more of the increase was this. And it wasn't anything specific, it was everything. It was labor costs, it was consumables, contractors, utilities, everything went up. So they were not blindsided, but they got hit each way from this. So it was nothing specific, but all those factors I talked about in the beginning of the presentation, that's the issue. And it's hitting everybody. The difference with gold companies is they're not seeing the revenue line go up like copper companies or nickel companies. They are flat to down. So their margin is getting squeezed. But they have the cash flow to last. So in terms of that, looks like on the sell side. This is really quick. So look at the big companies. Newmont has not changed their reserve price since 2014. $1,200 for reserves, $1,400 per resource. The gold price is much higher. So watch that. Do they adjust? Because if they do adjust to $1,400, Newmont suddenly finds 1 year of production, because that's what they deplete. So right now, I would, if I had to summarize, exploration trends, buy in terms of discoveries being made, M&A looks like a sell, balance sheets, buy, equity financing, sell, operating and capital costs, sell, reserve prices still look good. So if you had to sum it up, the majors still look good to do M&A. The trigger is when will they do it, but one of the things will be they'll have to increase the reserve price. All right, thank you very much.